Welcome back to our channel, Oahu Homes. I'm Ashley. This is Shannon. We're local real estate agents here on Oahu. We are powered by Turnkey Group at eXp Realty.
If you have any questions or are interested in anything having to do with real estate here on Oahu, please find our contact information in the description below. We'd be happy to work with you. Please enjoy today's video. Hey guys, welcome back to our YouTube channel. Today we are sitting at Align Mortgage and we are joined with Ben Fransen. Ben, why don't you tell the people a little bit about yourself?
I'm Ben Fransen. I'm a senior loan officer here at Align Mortgage. I help people with their home financing needs. I do a lot of VA loans, USDA, FHA, conventional. Basically, you name it. If you need help getting a mortgage, that's what I do. I've been in the industry for about 3 years now. So I've seen super low interest rates and relatively high interest rates. I kind of understand the different strategies that are out there to help homeowners or potential home buyers take advantage of the market that they're in and make it work for them. And that's what I'm all about.
Let's just get started with the first question being, if a person is looking to buy a home maybe in a year from now, how would you say they should get started on that?
First step is get educated. We hold regular monthly seminars here at our office in YPO. Sometimes we hold them online, but we do a couple different seminars. We do a VA homebuyer seminar, which teaches all about the myths around the VA home loan and what you can use it for, what you can't use it for. So if you have that entitlement, that VA loan entitlement, that's the seminar you want to check out. And if you are a non-veteran that wants to learn about homeownership, we also offer a home financing options seminar, which talks about the other different loan programs available to non-veterans. But starting with education and getting connected with a loan officer early is what I would advise, and then go from there.
And that's free, correct?
That's free.
Yeah, that's free.
Yeah, all of it's free.
And you get a credit, right?
Yeah, so if you attend one of our seminars, we give you a $500 closing cost credit. Of course, you have to close your loan with our company to get it, but yeah, that's a pretty good return on your investment because the seminars are only about less than 2 hours long. So it's like $250 an hour for learning.
Yeah.
So it's pretty nice.
As much money as you can, especially when you're home buying, right?
Yeah, absolutely.
What tips do you have for someone who's trying to buy a house for saving their money?
This would be a tip that would probably come up in your initial consultation. If we find out that you're in a situation where you need to save up some money, maybe you're looking to purchase a property in an area that isn't eligible for, like, let's say a USDA loan, which offers 100% financing. So you've got to come up with that down payment. Mm-hmm. We would explore options for that. Maybe we would explore the idea of gift funds. Down payment can be a gift from a family member. Mm-hmm. So maybe your parents are doing well enough that they can help you with that down payment. If that's not your situation, well, we help you figure out what you can do, what adjustments you can make with your budget to where you can actually start saving. Because if you're not thinking about how you can save the most money in the least amount of time, before you know it, you're going to need more of a down payment than you needed when you started saving. Yeah. Because the prices have gone up by then. Mm-hmm. So just kind of figuring out, what we've got to work with. Sometimes it's going to be a conversation about, whether or not you can earn more money than you're currently earning. What can you do to get to the next level in your job, in your income? I've actually helped clients find new jobs as part of this process. Hey, my wife works in the same industry that you're in. I could ask her, if you send me your resume, I'd be happy to pass it along to her and see if they've got any openings that might be a good fit for you. And we've done that and help people qualify by getting a better job. That would be one tip. The other would be just try to figure out what your unnecessary spending is. Write everything down that you spend money on, and at the end of the month, like everything, like if you go to Starbucks and you order a Frappuccino, write it down. If you go to the grocery store and order or you buy a candy bar, write it down. And then at the end of the month, you go through and you highlight everything that you bought that you didn't need, and you're conscious about that the next time you go shopping. You don't buy those things, and focus on getting into an investment so that your money can be going towards something that's going to help you build wealth and build your equity.
If anyone out there is interested in owning a home, it's always better to talk to a loan officer ahead of time rather than wait.
Some people will be discouraged. Maybe they don't think their credit is where it needs to be. Maybe they think they have too much debt. A lot of times when someone will come to me reluctantly to get pre-approved, thinking that there's no way they're going to get pre-approved, and they pre-approve just fine. Maybe they do have some debt, but it's not the total amount of debt that we look at. We look at the minimum monthly payments associated with that debt. So if depending on where the payments are and what your income level is, and your total debt to income ratio, depending on the loan program you're using, there's ways that we've been able to make it work for people that didn't think it would work. So yes, talk to a loan officer. It doesn't cost you anything to talk to a loan officer, and we're not going to pressure you into anything. We're about helping you realize the potential and help you achieve your goals.
So if someone doesn't have down payment, do you have access to down payment assistant programs?
There are different grants out there that are available for certain demographics, depending on what your income level is. Lower income families, there are down payment assistance programs. There's zero interest loans that you can get to help with down payment. So those are things that we do. There are also other programs for lower income families, such as the mortgage credit certificate program, which is basically a way. It's a tax savings. Your mortgage interest is tax deductible anyway, but that's a tax deduction. That means your taxable income is reduced a certain amount based on the amount of interest you pay. Therefore, you pay tax on a lower taxable income level. But with the MCC credit, they take a portion of that and they turn it into a credit. It's a tax credit. So it's an exact dollar amount back in cash that you get through, when you file your taxes. When we use that program, and you have to qualify, you can't make more than a certain amount of money. You have to be a first-time home buyer. There's some other stipulations, but if you're using that program, we can actually count that tax credit in your debt to income ratio so that you can qualify for a little bit more. So
nice.
It works really great with the USDA loan program, which is a zero down payment loan program, because now you've got this credit, you can qualify for a little more, even though the debt to income ratio guidelines on a USDA loan are a little more restrictive. And there's also some geographic restrictions associated with it as well. But depending on where you're looking to buy, it could be a great option, and the MCC credit could make it even an even better option.
And with the credit, that does run out yearly as well, right?
The IRS, the government, allocates a certain amount of funds towards this program. And once those funds are depleted, you've got to wait until they reallocate funds to that program. There hasn't been any funds allocated to that program for a long time until June of this year. So there are funds currently available for that program. So if that's something you're interested in, definitely let us know, and we can look into it for you and see if it might be something that you could qualify for.
When getting pre-approved, what are some of the documents that people would need to have?
Great question. It's going to depend on the borrower, but for most people that are first-time home buyers, the basic documentation that we look at, we go back 2 years for your income history. So we look at W-2s going back 2 years if you have a W-2 income. If you're self-employed, we look at your 1099s and your Schedule C tax return on your tax returns to calculate your taxable income. We look at your most recent month of pay stubs. If you have a 9-to-5 or any type of W-2 income, you're going to get a pay stub. So we go back 1 month for pay stubs. We look at bank statements to see what your asset situation is. If you have 401k or TSP or checking, savings, you provide us your 2 most recent months of statements for those accounts so we can kind of see what kind of assets we have to work with. And it's okay if you don't have any assets. Don't think that you have to have a bunch of money in the bank. We just helped someone buy a house and he got cash back at closing. And that's something that is possible in this market.
In this market,
especially when you're working with seller credit. But a copy of your photo ID, but that's pretty much it. Now, there are other documentation that could come up depending on your situation. If you're receiving alimony or child support, then your divorce decree or a child support order documentation would be required so that we can verify those funds. But basically, we're collecting documentation to verify your current financial situation, your income. We're going to pull your credit, and we're going to be able to see all the liabilities that are on your credit report, what the minimum payments are, and and go from there. See what loan program might be a good fit. See what price point might be a good fit. Help you figure out what price point you should target in order to get into the monthly payment that fits within your budget. Because with, especially with, loans that have no DTI restrictions, you can qualify for much more than you probably should. For example, if somebody has very little debt and they're using a VA loan, they might qualify for a $4,000 monthly payment if they make $6,000 a month. But that's a little bit irresponsible unless you have additional income that's not on your loan application. So in some situations, it's great that you can make that work. Maybe it's a situation where a service member has a spouse that works but doesn't have the best credit. So adding her to the loan application would actually hurt their pricing options if she's got a lower FICO score. So if we can make it work with just his income and it works with their budget, then it's a great option. But kind of figuring out where that line is and what price points you should be targeting is kind of one of the first steps in figuring out whether or not we can make it work.
So in general, what are kind of the benefits of buying versus renting?
A lot of reasons that people will rent because they don't think they're going to be in an area for very long. They'll rent because they think it's easier than buying a house. Some people have to rent. Some people, like, for example, if you're self-employed and you write off all your expenses against your taxable income, and on paper it looks like you make nothing. You don't pay any taxes, but guess what? You're not buying a house. Not with a traditional loan program, a conforming loan program, because you've got to have income to offset your debt. When you rent, 100% of the rent money goes towards somebody else. If you rent for a year at $2,000 a month, that's $24,000. Yeah, you had a roof over your head, but you're not getting anything back at the end of this year. Whereas with the mortgage payment, there's a few different benefits. One, the payment might be a little bit higher in total, but a portion of that payment is being applied towards your mortgage, your principal balance on your loan, and a portion of that payment is being applied towards interest. But at the end of the day, when you're done with that property and you sell it, whether it's 5 years down the road, 10 years down the road, 30 years down the road, you have equity in something that you would not have gotten by renting. It might feel like it's more affordable to rent sometimes. But if that's the case, we need to figure out how to make buying a home affordable for you, because that's how you're going to ultimately build wealth and be able to retire someday. How are you ever going to retire if you don't own a property? And if you constantly got to pay rent, I hope you've got a good retirement plan. Because my retirement plan is real estate. The properties that I bought that now have renters in them, and they still have loan balances and they're not paid off yet, but eventually they will be. And when they are, the rent money that I'll be able to get from those properties will sustain me in my lifestyle in my twilight years.
Let's talk about affordability. How can we make the payments more affordable for someone who's trying to buy, especially in this market? We've done it a couple times. Yeah,
so it is a tough market. Affordability is a challenge when interest rates are high, especially in a place like Hawaii. A payment on a $900,000 single family home, which isn't uncommon in Hawaii, as you guys know. If you're doing 100% financing, you're looking at a mortgage payment that's over $6,000 a month. That could be daunting for some people. There are ways to get the payment down a little bit. You can permanently buy down the interest rate. There's a limit to how much you can buy it down based on what the current mortgage coupons that are available, and that's something that's set by investors, really. They kind of set where that is. It's based on their investments. But so you can permanently buy down your rate. But there's the other option that works for a lot of people is a temporary buy down.
Yeah.
So there's ways that you can utilize seller credit to temporarily buy down your payment for the first year, the first 2 years, depending on how much credit you get to work with. So let's say you're able to lock in at a rate of 6%, and that 6% gives you a monthly payment of $5,000. But if you were to look at what the payment would be at 4% for the first year, let's say it'd be $1,000 less, just hypothetically. Now, instead of having a $5,000 payment, you got a $4,000 payment for the first year. It would take $12,000 in seller credit to get that for the first year. And then for the second year, you look at what the payment would be at a 5% interest rate. And the difference between the payment at 5% and 6% times 12 months, let's say it's $6,000.
Yeah.
Now, that's a total of $18,000 in savings that you would experience in your payment over the first years, the first 2 years of having your loan. You basically take $18,000 in seller credit, put it in the escrow account with the lender, and they distribute it over a 2-year period. For the first year at $1,000 a month, and for the second year at $500 a month. Now, this can be done in conjunction with a permanent buy down. You just have to have enough credit to be able to do that.
Okay.
And the seller credit is required for the temporary buy down, but you can choose to pay out of pocket for the permanent buy down. So sometimes people will choose to do that. They'll buy the rate down permanently as much as possible, and then also use seller credit to buy it down temporarily. One of the biggest benefits to the temporary buy down is that, let's say in a year you do a 2-year buy down, you got $18,000 in seller credit, your payment has been $1,000 less than it would have been for the first year. In 1 year, rates have dropped to a point where now you're eligible for a refinance into a 4% interest rate permanently. No guarantee that could happen, but it could happen. It's realistic. The remaining $6,000 that's left over in that escrow account from the original subsidy, it doesn't go away. It's not like that's a fee that you're paying to the lender. It's a subsidy that's given to you by the seller at closing to make it a little more affordable for you to fit this house into your budget. Those funds in the refinance process are applied towards the payoff. So, depending on the amount that's left, it could be enough to cover the cost of the refi so that, the loan balance at the end of the day hasn't increased, but you've just gotten into a lower interest rate, which would be the ideal situation. But one way or another, if you refinance 1 year down the road, 2 years down the road, 3 years down the road, going into it, you have to qualify for the full payment, and you go into it knowing what your full payment will be at the end of those 2 years. And that's important to know because we don't want to put you in a situation where you're not going to be able to, you can afford your payment now, but you won't be able to afford it 2 years after making discounted payments.
If the remaining balance of the buy down can't cover the cost of the refinance, are you able to work the refinance remaining into the loan itself?
Yes. For most refinances, people don't come in with any cash out of pocket. We calculate the amount of closing costs that there are. Some of the closing costs associated with the refinance are going to be costs to set up your new escrow account. But when you do that, you're setting up a new escrow account for your taxes and your insurance payments. The existing escrow account is going to get refunded back to you. So it's kind of like a wash almost. That's definitely a good question. You can roll the cost of the refinance into your new loan. The VA loan, they make us do a calculation to make sure that whatever costs are associated with the refinance, it can be recouped within 3 years. So legally, we have to be able to show you that the cost of the refi over a 3-year savings and monthly payment will cover that cost. Lenders are held accountable for that to make sure that they're not simply refinancing people over and over again when it's not actually to their benefit.
And how much does a refinance typically cost?
It depends on the loan program. It depends on things like whether or not an appraisal is required. Appraisal can be anywhere from $750 to over $1,000. That's a cost that could be associated with either a cash out refinance or a conventional refinance. VA streamline refinances don't require that. On a VA streamline refinance, there's a 0.5% funding fee for non-disabled veterans. If you're a disabled veteran, you don't pay any funding fee on a refinance, but that 0.5% funding fee can be rolled into the new loan. So if you're refinancing $1 million, then it's going to be a $5,000 funding fee that gets added to your new loan. There's some title and escrow fees, but they're usually discounted, especially depending on when the last time or when the original loan was. If you go through the same title company, they'll usually give you a discount on the title coverage. It depends on the situation, but it could be anywhere from $5,000 to $10,000, and that can also be covered a lot of times with lender credit. So like when you look at the cost of a refinance, you also have to factor in the cost associated with the interest rate that you're locking in. If you're locking in at a par interest rate that doesn't come at a cost or with any credit, then you can expect to just roll your closing costs into your new loan. Your loan amount is going to go up. Let's say that no cost rate was 3%, but maybe you're happy with a 4.5% interest rate and the payment that you would get with a 4.5% interest rate, and you could get some lender credit to cover some of those costs. Then your new principal balance on the loan wouldn't necessarily have to go up. It would get that lender credit could cover the cost of the refi.
What other options besides the VA loan are there 100% financing?
USDA loan is a great loan program for non-veterans who would like to take advantage of a 100% financing option. There are some restrictions. I mentioned some of them earlier. There's some geographic restrictions.
Okay.
When we're going through the pre-approval process, one of the things we factor in is where you're looking to buy. And if where you are looking to buy is eligible for USDA, then we're going to consider that as an option. It's not necessarily going to be the best option for everybody because there are tighter debt to income ratio guidelines associated with that. Like 43% is usually about the maximum back-end debt to income ratio that we can work with, whereas with conventional you can go up to 50% debt to income ratio. But with conventional you do have to come in with a down payment. If you're a first-time home buyer, down payment could be 3%. You have to take a class, but that's a pretty reasonable down payment amount. So if you're looking to buy something in town, then we really be, as a first-time home buyer, just trying to get you a 3% down payment to make it work.
What about an FHA 100% financing loan?
No, FHA is another loan program that has its place. It's a 3.5% minimum down payment on FHA. It is good for certain individuals. Somebody that maybe has some credit issues would be, an option looking to buy a single family home. There's not too many condos except for new developments that are FHA approved on the island of Oahu. There's just not that many that have maintained their approval with FHA. But if it's somebody that's, say, looking to buy a single family home that is under the loan limit that the FHA has set, it could be a good option, especially for somebody that doesn't have credit. There's some downsides to the FHA loan. You have to pay mortgage insurance for the life of the loan. But if it is a way to get you into the home, you can always refinance out of it down the road when you've got the equity to get into a conventional loan. We always look at the buyer as an individual and look at their scenario to figure out what makes the most sense for them.
One of the problems I run into with clients is that they think that their credit score is not good enough.
First of all, I would say don't worry, we don't judge you. I have not had great credit all my life. I've got decent credit now. I don't have perfect credit, but credit is something that it doesn't take much to mess it up. It takes a lot to get it to where it's great. You don't need excellent credit to buy a house. There are loan programs that are more forgiving with credit score. VA is one of them. USDA, FHA, they're all very forgiving with regard to credit score. If you're in a situation where your credit is not where it needs to be, maybe it's below 580, we're going to look at your credit report and we're going to give you an action plan on what you need to do or what you can do to start getting your credit moving in the right direction. A lot of times, just knowing how to allocate the extra money that a family has, what to allocate it towards, what debts to pay off first, that's sometimes simple. It's a simple solution to start getting their credit moving in the right direction. Know that whatever I see, it's like it's confidential. It's between us. I have a fiduciary duty.
It's like going to the doctor.
Right. It's like doctor-patient confidentiality. Exactly. It's like a lawyer. It's privileged information. I don't get on the phone and talk to you after I do a credit pull and be like, oh, so-and-so's got jacked up credit. I will just simply tell you, we've got some work to do. We've got a plan and we're going to need some time if that's the case, and you're not going to judge.
Well, I guess that's pretty much it. Thank you, Ben, for joining us today.
Thanks for having me.
And if you liked today's video and found this information helpful, give us a thumbs up, subscribe to the YouTube channel. Yeah, we'll see you next time.
Aloha.